So about us, we are leading in EdTech company, and we cater mainly coaching in FRM, CFA, MBA, and tools that we use, Python, Tableau, Excel. So it gives you competitive edge when you go on your jobs. So along with subject knowledge, if you have tools knowledge as well, and if you combine that, that will get you more fruitful results. And these are our website. You can always visit there. There are good knowledgeable blogs that are shared on these websites, so always visit there and have the knowledge upgraded.
All right. How much is your MBA?
MBA coaching, it depends. It's like how you want it for this time. It's just a yield to maturity. So it depends on what are the things that you want to cover. So mainly we go for hourly basis, but still, I mean, if you want complete packages, we are open for that as well.
So meaning you don't offer MBA, you only support like you do
Yeah,
with
that's correct.
FRM and CFA.
That's correct. Yeah, we are not
Oh,
university. We are just we just act as a catalyst for your degrees.
all right. Okay.
Yeah. But yeah, certainly we cannot offer you the piece of paper, but definitely we can get you your knowledge to the level wherein it can be best applied at the jobs. That's something we
All
can
right. Okay.
yeah.
Okay.
So I think mainly you wanted to understand this, so I'll focus on this. But if you're interested, we can go on these also. So let me just go back to this yield to maturity. So
Okay.
yeah. So firstly, see for example, there is a corporate X, okay, who is issuing a debt, say $100 million. I think it's just the basics of bonds that I'm covering, but I want to touch upon that. So and they're offering coupon of say 10%, just hypothetically, per annum, just for sake of understanding. Just understand that it's 10% per annum, and today say it's Feb 29th, 2024, and it has a maturity of 10 years. So say it will mature in 29 Feb 2034. So that's the basic details about the bond. So what will happen that, see, I mean, it is as on today, okay? So when we say go till 1 month down the line, so basically yield to maturity is something, if instead of entering at this date on Feb 29, 2024, say if I am entering as on 1st March or 31st March, just for example, 31st March 2024, if I'm entering into that day, what would be my returns? Okay, so usually how we do, like say for example, if I'm entering in some investment by investing 100 rupees or 100 SAR, and 1 month down the 1 year down the line, my investment goes to 110. Can you tell me what is the rate of return on this investment?
It's 10%.
10%, right? So this is a clear-cut calculation, but when it comes to bond, calculations are little tricky. So like YTM is something that helps you understanding that instead of say, see if you enter on Feb 29, for sure, like your, because what will happen that when coupon is issued, at that time as on Feb 29, market interest rate, so interest rate is 10%. So your coupon and yield. So when I say yield, that means rate of returns are same. That's why you're, but when you enter as on this date, market interest rate may vary. Okay. So you want to understand, if you miss this opportunity, what is the rate of return you will earn if you enter in as on this date. So that's something which is given by your yield to maturity. Is the understanding clear?
Okay.
Then we will go on the mechanics or mathematical part of it.
Okay, let me understand.
Sure,
Meaning the
please.
yield to maturity is like expected return. It's not, it's an interest, it's like a forecasted
Yes.
interest.
Yeah. Yield to
Oh, all right.
maturity is like, yeah, your expected return given you held your investment till maturity. So that's
Yes.
why it's called as a yield to maturity.
Okay. So how does it differ with the, oh yeah, it's different from coupon rate because coupon rate is something that you are being promised to pay. It's like an interest rate that you're gonna get by investing your par value.
Yeah, that's correct. So in fact, let me just add to what you said. See, for example, on a day zero, when this bond was issued, okay, your coupon
Yes,
is 10%,
yes,
okay, and your market interest rate is also 10%.
yes.
That's why it is, let me call third column as price, which is 100 because it would be priced at par when the coupon is issued on a date. So it's 10%, market interest rate is also 10%. That's why it is priced at par. Now, say 5 days down the line, coupon will not change. Coupon is going to
Yeah,
remain
coupon will
same
not
for,
change.
yeah, 10
Yeah,
years.
yeah.
Okay. And but if your
Yes.
market rates go down, say 7%, just hypothetically, can you tell me what could be the price and reason?
Okay. I can't be able to state the price
But yeah,
like
will
the
it be
price.
greater than
No, no, the
100 or
price
less
will
than?
be
Yeah,
the price will be that 100 divided by 1 plus that 0.07 because the price is present value, right?
yeah, that's correct. But can you tell me
Yeah.
just, I mean, not a calculation part, but just will it be greater than 100 or less than 100? With if the market interest rate goes to 7% and your coupon is 10%.
Okay. It will be greater than 100 because
Yeah,
the value of the bond it's inversely related to the interest rate.
fantastic.
Meaning when the interest rate goes down, the value goes up.
Fantastic. And reason for that is like, yeah, you're perfectly right. And but what is the rationale for that? Can you explain me that? That's the key thing that you are actually expected to understand being a FRM candidate or a finance professional.
Okay, the rationale behind the value and the inverse relationship between interest rate and the value.
Yeah, and so let me just add to you. So why there is an inverse relation, I'll explain you that. That will help you. So why there is, let me just write in a mathematical notation because that's quite easy. Why price is inversely related to interest rate. So these are the notation. So I mean to write inverse relation between two variables. So reason being, now listen to me carefully. Like see, your bond that you have invested is giving you 10%. Okay. If new
Yes,
investor is entering into a market, he will get only 7% because your
yes,
bond is giving you more interest on your investment. That is why it trades at a premium. So it will be more than 100. That's why we say that when your market interest rate goes down, your the bond price will go up because it is giving you more returns as compared to market. That's why uh, the demand for this bond will be more. So the price of the bond will be at a premium. It would be greater than 100. Does it make sense to you?
yes.
Okay. And likewise, now can you explain me? Say, for example, coupon is 10% and this goes to 13%, say.
Okay. Since the market is offering 13%,
Hmm.
um, that bond is gonna trade at the discount.
Perfect. Because your bond is giving you just 10%. But if I have two options, if I were to buy your bond that you had invested in, that will give me just 10% per annum. Whereas if I go to market directly, that will give me 13% per annum. That's why
Yes.
the new bond that would be issued in the market would be so our bond will be at discount, and of course market bond will be issued at par. But yeah, definitely this bond will trade at a discounted price.
Yes.
So that's why we say our price is less than 100. Does it?
Okay.
Yeah. And in a simple terms, this is a YTM actually. So whatever is your market interest rate, that is called as a yield to maturity.
Okay. Yield to maturity is market interest rate.
Yes. So it gives you,
Okay.
if you say, for example, these are 10 years bond. So it gives you the number or expected return if you held your investment for 10 years. So it's like over here is 10% when we had bought our bond. But if market interest rate go to 7%, so this is 7% actually. The Y actually becomes 7%.
Okay.
So yeah, that's how these bonds are actually. So of course, in mathematical part, I'll explain you that how. That's why what happens. See, can you tell me? I think you are now FRM candidate as well. So can you tell me if my value of my money after 1 year is 110, what is its value today? If
If the
your
interest rate is how much?
perfect question, 10%.
Okay. It will be 100 because present value equals future value times no, future value is equals to present value times the future value factor raised to power t.
Yeah, that's correct. Present
Yeah,
value 1 plus r to the power t. So like we
t.
can just plug and play and get the present value, which should be 100. In a similar way, what we do, like when we try to calculate price of a bond, we try to calculate, so we substitute coupon, which is 10 in our case. Okay, so these are the coupons. And YTM is
Yeah.
what you will do. You will observe what is the market interest rate for 1 year, what is market interest rate for 2 year, and you so that's the way you calculate your price. So you discount here. So like as you said over here, the 1 year interest rate was 10%. So I will put 10%, and my coupon is also $10. So 10 over 10%. Likewise, there would be some interest rate for 2 years. So there is a proper term structure for all the maturities. Those are substituted in this one, and you get your price. But in practice, is it clear? Are we clear so far?
No, it's not clear whether suppose in year one we have that 10% and
Hmm.
year two we have 7%.
Hmm.
Are we gonna substitute the y's in the denominator with the market interest rate?
So see what
Or we
happens.
only use one interest rate?
So see, I'll come back to this equation later. But currently, what I'm explaining, how do we derive price in general? So it could be R1. This could be R2. In general, what happens that your if I talk about practical thing, so if this is your horizontal axis, your time, and this is your yield. So actually what happens your as and when you invest for a longer, your interest, you get higher interest rate, because if you invest your money for 10 years, you expect some higher returns because you are locking your money for locking your funds for a longer time. So the price is higher. So in general, this R would differ, like for every uh, point time point here, your yield would differ in practice. So are we clear on this? So actually you will observe the market interest rate. You will get a term structure for all corresponding yields, say 1 year, 2 year, all the way till 10 years. You will get your interest rate, you will substitute here, and you will find your price. So that's how the price is calculated. Are we clear on this? Then I'll come back to yield to maturity, how yield to maturity is calculated.
Okay. Um, since the interest rate do fluctuate,
Hmm.
how true is the assumption that the interest rate is gonna increase as time to maturity, with time to maturity, like the longer the period you say, the higher the interest rate. So I want to know, the interest rate is driven by the forces of demand and supply. So
That's
it
correct.
does
Yeah.
fluctuate.
Yep, that's
Yeah.
correct.
Yeah. So how
So
true is the assumption that interest rates goes with maturity?
So interest rate will go up with maturity, as in say, for example, as on if I understood your question correctly, or let me just put in this way, if you're doubt, I can address. So as on this day, as on today, you have two options. Either you can invest your money for 1 year or 10 years. So over here, say you would be offered, say, I mean, if I talk about Indian context, you might be offered, say, around 8% per annum. But if you just go till 10 years, you will have 10% per year as on same day. So I'm just standing today. Okay. Today I'm standing
Yes.
and I want to invest. I want to take a call whether I have to invest for 1 year or 10 years. So these are two rates I have. So 2% premium is for like locking my funds for longer period of time. So is that a question? I mean, does that clarify, or you were asking something else?
Okay. You're saying the 2% between 8% and 10%, it's the maturity premium.
Like, yeah, that's correct. That's what you can
O-
say. There could be maturity
Okay.
premium. Yeah, because you will not have a liquidity for 10 years. So you will ask some for something. You can say maturity premium or a liquidity premium because you won't have this access to these funds for next 10 years. So like you will ask for something extra on for that, locking for those 10 years.
10 years, meaning the maturity premium, you request the maturity premium during the start of the indenture, like the bond indenture.
Yeah, that's correct.
Okay, all right. I understand.
Good. So, so this is something rate is plugged in this bond. So this is something which can be observed from. See, usually this interest rate is that is used for discounting is from the government issued security, because that is something. Of course, there is a broader world to it, but yeah, for sake of understanding, you can think these are the government deposits. From here, you can take a this interest rate to discount your cash flows. Those are the best proxy to discount your cash flows. So that's how the price of the bond is calculated. Now, uh, just one question for you. Say, for example, if I give you the price, okay, and if I ask you to calculate rate of returns, any thoughts on this? Will it be possible if I ask you to calculate R1, R2, R3, all the way till R10, if I give you the price?
Yeah, I think that will be that can be done,
See, over here, there are
provided the R1, R2, R3, and R10 doesn't change, like they don't fluctuate.
Yeah. See, for
If
example,
it's one rate,
yeah. See, for
if it's one
example,
rate, I think
yeah, on this day, say 31st March, I say that price is 98. So your P is 98. Get me R1, R2, R3, R10. So will it be possible to get that?
yes.
How?
Okay. You are saying now we know the R1, right?
No. I mean, all these are unknown. Just initially what I mean, explained you, it was a direct way. Like your interest rate for R1, R2, R10 were given, you calculated price. Now I'm saying if you are given a price and I want to calculate all these. So your
No, it's gonna
price,
be
yeah. So the answer is getting all these different values is not possible. That's why the
yeah,
easy way to calculate is single value that that
yes.
equates the price and these cash flows. That's how the yield to maturities is that's why it is called as a yield to maturity, expected returns if you held your investment till maturity. Does it make sense? To answer,
All right, all right. Because we're not gonna be able to get R1, R2, R3
yes,
until R10,
yeah,
because they do differ.
yes,
We
that's
have to
correct.
find just one rate that will
Perfect.
discount these cash flows to maturity.
Perfect. Yeah, that's correct. So that's the yield to maturity because see, mathematically also these are 10 variables and I don't have a much information. So just 10, getting 10 variables from this one equation won't be possible. So what we do, we calculate just YTM.
Yeah.
Yeah, that is called as, but in practice, how things work, usually there is a process called bootstrapping. You might have read in your FMP. Like what is observed, we take 1 year bond. Say if I just know 1 year bond, if there is just one coupon and principal payment at 1 year later, so I can calculate R for 1 year. What is the discounting for 1 year? So likewise, if I know 1 year, then I can go up till I will pick some 2 year bond. So slightly different. I mean, slightly off the topic, but yeah, that's a different thing that I mean that is done in the practical. So what is done actually? So if I were to price this bond, what I'll do, I'll go to market, I'll observe the price of 1 year, 2 year, and 10 years bond, or other ways, notice the government deposit rate that you can use for the deposit. So either ways, so both are correct way. But in practice, actually what is done, the actual bond price for 1 year, 2 year is noticed, then R is calculated, that is substituted here, and bond price is calculated.
All right. Okay. So yeah, I think that bootstrapping is also in book 4. That's
Yeah,
where I'm struggling. You remember I told you that I was struggling with book 4 and book 2.
yeah, I recollect. Yeah, I would be happy to assist.
Yes.
I know now you have assured us that you would be with us in a second of year.
Yeah, I'm going to be with you in the second half of the year from June
Yeah,
until December.
sure thing. Yeah. And
Yeah. Okay.
would you like to solve this problem, or do you want some Excel demonstration of this thing that will help you a lot? Do you want me to
Yeah.
show it on an Excel?
Yes.
Okay, just give me a moment. So, are you finding it interesting, first of all?
Pardon?
Are you finding learning interesting?
Yeah, it's very interesting.
Yeah, great. So just going back to our example wherein we had bond with coupon of 10%, okay, and maturity or N is say 10 years. Of course, you have to do this calculation in your financial calculator, that is VA2 plus. And like initial price was say 100 that was issued. And what else we need? And of course, YTM when it was issued, it is 10% because that is why your price is, I mean, your bond price is at par. So your coupon and YTM are at same price. So let me just, so this is at issue date and say, let me ask you to calculate price when I think we discussed YTM was equal to how much? I gave you 7%, right?
Okay.
So that's the problem statement.
So I should calculate the price using the calculator.
Uh, in exam you have to do, but over here I'll use demonstrate using the Excel.
All right. Okay.
Okay, so we'll say this is year 1, year 2, year 3, year 4, year 5, year 6, year 7, year 8, year 9, year 10. Can you tell me what are the corresponding cash flows?
It's 10% of 100 is 10.
10. So on year 1, you have 10 all the way till year 9. Can you tell me what happens
Yes.
at year 10?
At year 10, you have 110, 100 plus 10.
Perfect, yeah. And like we had to calculate the present value. How do I calculate present value? The formula was coupon divided by 1 plus. Can you tell me what would be my rate of interest?
10% in year 1.
Uh, 10% was a coupon.
Oh, 7%, because
7%.
10% is coupon
Yeah.
rate. It's the
So
coupon rate, yeah.
yeah. So
The
in denominator
7%,
we have
because
YTM or market rate. So this is how you calculate your price. So if you notice, your price is at premium. Of course, interest rate will not go that much down, and this is very hypothetical scenario. So 186 is a hypothetical scenario. And now tell me what could be the next thing, like say it goes to 13%.
okay. At 13%, the price of that bond should be lower than 100.
So cash flow,
Cash flow is
PV,
going to be 10,
yeah,
still 10,
yeah, these
because the
both
coupon
will be
rate is the
same.
same. Yes.
I think, yeah, year cash flow. Let me just copy this. PV, what it would be? Coupon 1 plus or
1 divided by 1.13.
it's 1 plus, let me just make it simple. 110 divided by 1 plus 13%, because we have 1 dividing by adding 1, so it is just 0.13, so it will become 1.13 as you said.
But
Yeah.
you didn't take into account when calculating the first PV at 7%, you didn't um, take into account the time value to say T in the discount factor.
Very nice point. Good point. Yeah. Thank you.
Yeah, yeah.
So over here it would be this one. Very interesting one. Yeah,
T will
thanks.
be
In fact, I
1.
was wondering
Yeah,
186 very unrealistic price.
yeah.
It's 121. Thanks. Good one. So in the same way, how will we do? We'll just calculate 13%.
Yes.
Yeah, so it is at a discount rate. Likewise, what we can do now, I'll just make it more generic. Okay. So say for example, this is your YTM and this is your price. So you can do calculation for 7%, 13%. Now I'm making it more generic. Say your yield is at 10%, 0%, and 0%. Just let me increase it by 1%. So all the way till, say, let's go till we came from 10 to 0. Let me go till 20%. Oh, it's not happening. No. Yeah. 17, 19, 20. Now let's calculate what are the corresponding prices. Of course, see, instead of doing this all this calculation, your calci also has a direct formula. But in this also, what you can do, you can calculate PV, rate of interest. Say this one is my rate of interest, 0%, and n per. So only one payment is once a year, and payment is 10. Okay, and future value is 100. So that's how you calculate the price of the bond. So let me just make it do it for 7%. Let's to verify. I think we have done something incorrect.
Yeah, because it's giving a negative. Oh, the payment should be, I think the
Yeah,
payment
it would
should be
be. Yeah, I
negative.
mean, you can just either way. So negative, that's fine. It's 90. We can also make it -100, but I was just expecting this one. Let me just verify what's wrong here.
Yeah, to be same as,
Ideally, my present value, this is rate.
The rate stands for the coupon rate. Is it the rate, coupon rate, or the yield to maturity?
Let me just do in this way. Now I think we are correct. Do you notice? I think it's
Yeah.
making sense. But why the sign? Let me reverse the sign. Why it's not working? I'm changing the sign. In this way, it's correct. 121. Let me just multiply with -1 in interest of time. So now we're good. So if these
Okay.
are the range of the prices that you will get, you will see that the price. Let me just plot this. It will give you the better insight. So this is a price yield relationship. I have to access. I have to put some labels. So these are, of course, there are a lot of data points, so it look dicey. But if I were to just do this, we just make it 20, slightly steeper. Or let me make it 5. I mean, just want to demonstrate the inverse relation. This doesn't look good. Yeah, let's look at. I mean, just visualize that as and when this was your issuing interest rate, that was coupon. As and when your interest increases, your price is going down. So your y variable is going down as in we move ahead towards right. And likewise, if we move ahead, if we move towards left from this coupon, your price is going up all the way till 200. Does it make sense?
Yes. Yes, it does.
Yeah. So likewise, the coming back to your point is like your YTM is just nothing but if you are given this price, what is the discounting rate that you're using? That's the only interpretation of YTM. It is expected return given you hold your investment till maturity.
Okay.
Yeah. Hope you found it interesting. Anything else that I can help you out with?
Okay. Yeah, the other thing that I'm struggling with, it's in terms of the capital asset pricing model and those unders and overvalued security. I understand. What I understand is that you will have CAPM as your equilibrium measure, like how much is the worth of this asset in the market, right?
That's correct. Yeah.
So that price will be determined by the CAPM. You can use the CAPM to price your asset, to price the asset that is in the market, meaning all the prices of the assets in the market is gonna lie in the CAPM line. Am I right to say that?
See,
Are they supposed to lie there?
I can demonstrate that it is not really so like you can have CAPM to price your stock, like instead of investing in a fixed deposit, what is the additional return that you can expect over and above risk-free rate? Say for example, if you're investing in a fixed deposit, then from FD, if you're moving to stock, what is the additional return that you can expect? That's something that is told by CAPM.
Okay, meaning the market return, because now I'm not investing in a, suppose a fixed deposit or fixed security is the government bond, right?
Hmm.
So the government bond only have a risk-free rate because there is no risk. Like,
Beta.
yeah, there is no risk because there is no risk of default, there is no market risk, there is no liquidity risk. That's why most of the government bonds are priced at risk-free rate. So now that I'm investing in the market, in the stock market, so I will like request the market premium, right?
Sorry to interrupt. We may get disconnected in a minute. Just resume or just rejoin. I'll be happy to assist in this.
Okay.
Yeah. And can you repeat your question in meantime? If you get disconnected, I'll connect back to you.
Okay. So what I'm saying is
Yeah. I mean, I had liquidity.